Good morning. Welcome to Trading Hour. I'm Reema Tendulkar. With me is Subhi Upadhyay, and now the momentum is picking up in the markets. The start was very quiet, very flat, but now we're up 100 points on the Nifty. The Nifty is comfortably above 24,900. Mid-caps are outperforming. The Nifty banking index is up close to about 300 points. And outside of that, pockets like oil marketing companies. So BPCL is the top Nifty gainer, a more than 5% rally. Remember, crude prices have seen a decline of 8% in the month of July, now sub $80 for Brent crude. So that's pushing up oil marketing companies. Power is a big theme which is emerging. Some buying is emerging in stocks like Tata Motors, Coal India, Asian Paints. Bright green screen.
Absolutely, and today is looking much better compared to the sell-off that we had yesterday. And actually, barring IT, almost all other parts of the market are seeing some buying or the other. And some are seeing more buying than the others. But yeah, that's the only weak spot. And even that IT index is now recovering from the lows of the morning. The mid-cap screen is looking very bright, about 0.5% up on the mid-cap index. So mid-cap's doing better than the frontliners. Just to talk about some of the movers and shakers on the Nifty. You've got some big moves in oil marketing companies. And guess what, I mean, when you first see these HPCL numbers when they came through with a lot of under-recoveries on LPG, it seemed like a big miss, but I think the operational performance is what the market's really focusing on. That stock's recovered. The other OMCs are doing really well as well. And some of the commentary that we had from the power majors, the PSU power majors, NTPC and Power Grid, that has gone down very well with the street. And we'll talk more about that as we go. But some of these stocks, Power Grid, in fact, about 4% higher, ditto for NTPC. So these stocks are doing really good. Some consumer names are shining bright. There is Titan, which seems to have found its sparkle again. Lever is doing well. And I mean, if you're talking consumer, have to mention Colgate. Stellar performance. Really sparkling this quarter, and that stock has been up and about. We'll talk about a lot of these stocks as we go forward. In short, it is a really bright looking screen. But we're starting off actually with some primary market action because there's a new IPO on the street as well. So let's talk about it. Akums Drugs and Pharmaceuticals IPO has opened out today. The issue is going to be open till Thursday. That's the 1st of August. And the company, I think, is looking to raise a sizable amount of money as well. If I remember correctly, almost 1,800 crores plus. So we have Ekta joining in with more details on the company and the issue. Ekta.
Well, yes, Akums Drugs, that's opened its IPO today. It is the largest CDMO, which is serving the Indian pharmaceutical industry currently. It gets around 78% of its sales from the CDMO business and 95% of its EBITDA from the CDMO business. It has around 30% share in the Indian CDMO market by value. Now, the branded and generic formulation segment is around 16.7% of their sales, and API is small, around 5% of their sales. Now, they have around 1,524 clients as of FY24. They manufacture over 4,100 formulations across over 60 dosage forms. Majority of its sales is from the domestic market. Their exports are around 15 to 17% of their sales. The price band 646 to 679 rupees. Issue size 1,800 to 1,857 crores. Fresh issue of around 680 odd crores, OFS of up to around 1,176 odd crores. Post-issue market cap 10,200 odd crores to around 10,687 crores. The funds are going to be used to repay debt, so around 357 crores plus the remaining for general corporate purposes. Now, the company has already raised around 828 crores from 50 anchor investors at 679 rupees per share. Now, if you just compare it to its peers, Akums did an FY24 revenue of around 4,178 odd crores. The adjusted margin post a put liability is around 12.2%. Compare this to its peers such as Divi's, Suven, Innova, CapTab. All of them have higher margins. Even adjusted margins are lower than those. Now, the peer comparison, if you look at it on an FY24 market cap to sales, Akums is at around 2.4 to 2.5 times. The others on an FY24 basis are more expensive. Innova, CapTab around 3.4 times. Now, on a PE basis, there is a discount for Akums at around 28 to 29 times as compared to, say, Innova CapTab, which is at around 34 times FY24 trailing. Divi, Suven, obviously much more expensive.
Ekta, very comprehensive. Thank you for explaining that. We now have Sandeep Jain, the Managing Director, and Sumit Sood, the CFO of the company, now joining in. Gentlemen, congratulations and thank you for joining in. Sandeep, I think that EBITDA margin number that Ekta was telling us, 12.2% on an adjusted basis, is still much lower than the industry average. Can you explain why that is? And also, is there visibility, or does your business model have the levers to improve margins from current levels?
So, the way we look at what she's explained is the overall EBITDA margins of the group. The way the margins are for the CDMO business, they are at 15%, right? We think that the margins are going to be stable at 15% for our CDMO business, which she mentioned is almost 94% of our EBITDA. But some of the smaller businesses which we still are investing in, once they turn profitable, our overall margin should see a jump. So I think we are into contract manufacturing. The margins have been kept that way.
Okay, so how long do you expect these other businesses to drag down the consolidated margins? When do you expect a turnaround in them?
Ma'am, so the API business, the way we look at it, by the end of this year should turn around. And the marketing business also, we think by the third quarter this year should turn around. Coming back, while she was explaining, the anchor book was of 31 people. And in the anchor book, we got all the marquee investors. We've got Capital, we've got BlackRock, we've got Adia there, we've got SBI Life. So just to name a few. So I think it's a strong asset, and that's the way we look at it right now.
Got it. Yeah, you do have several marquee names in the anchor book, no doubt about that. We're just trying to understand the business model a little more. Let me bring in Sumit Sood, CFO of the company as well. Sumit, just take us through the debt levels right now, because again, compared to some of the listed peers, your debt levels are a little more elevated, close to, I think, 0.7 times. What's the plan there? Will you be utilizing some of the proceeds you raised to pare down debt? And what's a comfortable level that you'd like to target, eventually in the medium term?
So, ma'am, the fund-based debt are around 447 crores, right? And we have cash and cash equivalent, which is around 280 crores. So our net debt is around 220 crores. So, so of the proceeds of 680 crores, we'll be paying 387 crores for the debts. The cash flows of the company are very strong, so we think that we should be on a no debt position. Just to let you know, the term loans on the company are 123 crores. What is high is on the debt side, what it is showing higher is the working capital. So I think that's in the inventory of the debtors. So we should be debt free.
When? Sumit, you said that you should be debt free by when? I mean, is it this year itself?
Post our listing, ma'am. Just post our listing.
Post listing. Okay, got it.
Post listing, we should be debt free. Yes.
Got it. Let's get in a word from Mr. Jain as well. Mr. Jain, just give us some more perspective on the strategy now in terms of growth. There's the CDMO business, there's the formulations business. What is it that the company will focus on to drive growth? And again, I know you can't talk numbers, but in terms of an aspirational top-line run rate, multi-year run rate, I mean, do you tell your team to target 20%, 25%? What's the overall big picture game plan, and which segment will drive it?
Yeah, ma'am, we are the largest CDMO player, and we want to be in the CDMO space, mostly into the CDMO space. Presently, we are the largest in the country, but we are 25th largest in the globe, in the world. Means we do have 24 more spaces which we have to climb the ladder by 24 ranks. And we are two of our plants are European GMP. They have got European GMP just a year back. Now we are trying to leverage those two plants for international market as well as for CDMO space for some for some different players. This will be the first lever. Then, as far as marketing is concerned, we are there into marketing, and we will multiply this marketing business as well. API business, we are not into hurry to say double the production or triple the production. We just want to scale it up, at least for the EBIT margin to be in positive initially.
Now, you mentioned two, geographies in Europe where you've got the GMP. I believe your target is to, increase exports to about 25% of your total revenue. They're at 17% right now, Ekta was telling us. So by when does the scale up happen? And again, internationally as well, which are likely to be your biggest geographies, say by the end of the year?
See, ma'am, we are already there into 65 countries, and now we are moving up for some European countries, and as well as the countries which have been left. By when, say, 25% is the target of this financial year alone.
Okay. Sumit, branded generics is about 16 to 17% of your sales. What is it growing at? And if you can give some guidance on the further scale up in branded generics.
Right. So the way our business over the period 21 to 24 has grown is at a CAGR of 15%, right? So if we specifically talk about the branded generic business, we think we will continue to be growing specifically at that business at around 20% year on year.
Okay, so 20% growth in branded generics should continue. And in terms of revenue contribution?
Ma'am, I think largely the revenue contribution will remain the same because the CDMO business would also grow, right? So I think overall, it should remain the same. We'll sort of have 75% of revenue from CDMO.
Okay, thank you very much, Sandeep and Sumit, for joining in. We wish you all the very best and look forward to more regular interactions. Get into a break. On the other side, we'll put the spotlight on the big movers in today's trading session. We'll kickstart with the power stocks.
Welcome back. You're with us on Trading Hour. Two power stocks in focus, both on Nifty. Companies, I'm talking about Power Grid and NTPC. If you go back and remember, the NTPC came out with good numbers. Power Grid didn't have such a hot quarter. But the analyst commentary that the companies have provided has definitely worked really well on the street. You can see that. They've given out a lot of targets, medium-term and long-term targets. Let's go across to Vivek to get the highlights. Vivek, what did you make of it?
Well, despite having differing operational performance in today's trading session, both of them are having a similar up move that we are seeing, almost 3.7% up, both of them. So what actually happened is that over the weekend, both of the companies, came out with the results. Yesterday, both of the companies held analyst meets where they reiterated, the key numbers in the case of NTPC, what is the kind of capacity guidance that they're looking at? In the case of Power Grid, what is the kind of capitalization that they are targeting for the coming years? So NTPC, let's look at that one first. NTPC has said that out of the total 80 gigawatt that India is looking to add as far as thermal capacity is concerned, NTPC will be adding close to 26 gigawatt. So that capex comes up to close to $7 trillion. Along with that, renewable energy capacity addition that the company is targeting till FY32 is close to 60 gigawatt. So targeted commissioning in FY25, what is it that the company will add is in thermal 2 to 2.5 gigawatt and pumped hydro storage close to 1 gigawatt. Commissioning between FY25 to FY27, company is looking to add commissioning of close to 7 gigawatt, and in the renewable energy space, almost 16 gigawatt. So very strong capacity addition guidance is what the company has given. So on the back of that, regulated equity is expected to see double-digit growth over the next few years. No wonder then, most of the brokerages are quite positive. Jefferies continues to reiterate a positive buy stance, raise the target price to 485, and CLSA too, very positive with an outperform rating, target price at close to 441. Now coming to Power Grid, in the last couple of years, what's actually happened is that given the kind of transmission capacity that India needs to develop in order to go ahead and meet the power demand, the company has consistently gone ahead and upped its capitalization as well as capex guidance. So in terms of the capex trends, what is it that the company did in FY24? They gave a guidance of 8,800 crore. They ended up doing close to 12,500 crore. FY25, they started the year saying that they will do capex of close to 15,000 crore. In yesterday's meet, they have upped it to 18,000 crore, a significant upgrade coming in over there. FY26, they're targeting over 25,000 crore. FY27, over 30,000 crore. In terms of capitalization, FY25 capitalization guidance of now 18,000 crore versus an earlier guidance of close to 15 to 16,000 crore. Along with that, remember the company has also given positive commentary in terms of the actual works in hand, in terms of the transmission bid pipeline, and also the smart metering opportunity that they're looking at. No wonder then both the stocks today are doing quite well.
Okay, thank you very much for that. But the stock which is sparkling is Colgate. Very strong set of numbers. Strong teeth make for strong stocks. It's a 6% gain on that. Mangalam joins in. Mangalam, I remember 1-2 years back, the company was struggling to generate volume growth. Competition was eating into it. But this quarter, it's a very strong volume growth, high single digits, good margin performance. It's all, coming together for Colgate.
Well, it's called a coming together. 2 years ago, the company was actually struggling for growth, etc. And then they went ahead and made a leadership change. So Prabha Narasimhan joined from HUL. And for FMCG companies, typically a leadership change is one of the biggest triggers for growth. And over the last 4 quarters or so, the prognosis of growth, the plan that they had for growth, which is increasing usage frequency, increasing penetration, at the same time premiumizing, and also looking to sell more of their devices, which is toothbrushes, etc., and growing Palmolive. All those factors have come in together for Colgate this time around, and 13% growth is what the company's posted in their revenues in the first quarter, with a 21% EBITDA growth, margins up by about 240 basis points. This despite them having increased their ad spends by about 10% as well, and the net profit growth at 33% is definitely working for them. Favorable macro environment is doing a lot better because, they have seen rural recovery outpacing urban over the last 2 consecutive quarters, and they've seen high single-digit volume growth in the toothpaste business itself. The last few campaigns that they've had, including the ones that, probe people to brush twice daily, have done well for their overall volumes. Brokerages are positive too on Colgate. Jefferies has actually seen the 3rd straight quarter of upgrades for the company. This time around, they've upgraded their EPS estimates by 6%, and they've revised their target price from 3,020 to about 3,570. ICICI Securities says that they've estimated the volume growth at around 8%, with price mix being about 5%, talking about premiumization as well. Their only risk is that if they continue to increase prices, then maybe there could be some market share loss to naturals, and at 50 times FY26 price to earnings, they might not be very comfortable with the valuations, and as a result of which they have hold. Bank of America, they have an underperform rating on the stock, but they've increased their target from 2660 to 3175. They've also ascribed a 20% premium to the average forward multiple that the company traded at over the last 5 years. And valuations, they say, factor in medium-term potential. But if the company continues to grow faster than the industry and, in a slow-growing category, outpaces all the others with favorable rural macros, who's to say that it may not continue its outperformance, because it's already up 100% in the last couple of years, ever since Prabha Narasimhan took over. And if the growth continues and the company does go ahead and announce some sort of inorganic acquisition, as they've been pointing out earlier as well, then maybe the street would look at it differently.
Oh, what a show and what a quarter. Just a quick question, Mangalam. So the toothpaste business has done exceedingly well, oral care. What about the Palmolive portfolio? I mean, is growth also coming in from there, or is it largely oral hygiene?
So Palmolive has been growing at 2x the pace of the average growth of the company itself, but Palmolive accounts for sub 5% of their overall salience right now. So even if it does grow at 2x, the overall the needle does not move as much. But if it continues to do so and gets to a sizable chunk of the market, then maybe Palmolive would be a further growth driver for the company. But as of now, they've been wanting to leverage the Palmolive brand a lot more. The company is called Colgate Palmolive, but the salience of Palmolive is sub 5%, which is why they've done a lot of relaunches, etc., new ranges that they've launched as well in body wash, and they've trimmed some of their portfolio to focus on growth here. It's been doing well, but it's too small in the overall scheme of things yet.
All right, that's important to keep in mind. Though, of course, all the relaunches and all, they've caught my eye, at least on the shelves for sure. So let's see how it progresses. Thank you so much for joining in with Perspective on Colgate. Absolutely fantastic quarter from the company. We will take a break. When we come back on the other side, talk technicals. We'll have Mitesh Thakkar joining in with some trading ideas.
Welcome back. Autos are revving up. Look at Maruti. Maruti suddenly spiked up. Remember, it reports numbers tomorrow. Maruti's seen some buying. Hero MotoCorp is also pushed higher. It's now 1.6% higher. And of course, the top gainer or one of the big gainers today is Tata Motors. And I think Tamo reports numbers on Friday. Incremental buying coming through in many of these auto names. But now let's get you excerpts from an exclusive conversation. Sanjeev Goenka, Chairman RP Sanjeev Goenka Group, told us that they intend to reach a market capitalization of 2 lakh crore in the next 30 months. In conversation with Shireen Bhan, he also discussed the overall group's growth outlook and how they plan to grow Philips Carbon Black and their renewable business.
Over the next 12 to 18 months, we will be spending about 35,000 crores, and over the next 3 years, about 50,000 crores.
And what's the growth aspiration? You've now got a market cap of almost, $7 billion. What's the growth aspiration?
We touched 70,000 crores this morning, I'm told. And this is without taking our unlisted ventures. But over the next 30 months, 2 lakh crores. I would expect to see over the next 5 years at least a 5 times growth.
A 5 times growth from
5 times growth from what it was, 490. I would expect it to be at the 490 translating into between 2,400 and 2,500.
All right, and those stocks from the group are doing really well today. Both CESC as well as PCBL, what was earlier known as Philips Carbon Black. Big move on those two. Let's go across to Mitesh now, get some more trading ideas going. Mitesh, good to have you with us. So tell us, the market's picking up some momentum. What is the thought on the index and, of course, individual stocks?
So, good afternoon. My sense that I think 25,000 remains an important hurdle, purely because of the fact that one, psychologically important level, two, I think a lot of call options have been written over there. So we have been advising not to trade the index for the time, maybe, about 25,000, maybe you will want to take a long trade with a 80, 90 point kind of a stop loss, but wait for that breakout to happen. Till then, I think trade with stock specific bias because very clearly a lot of action is happening in the individual stocks as well.
And then you want to tell us your individual stock recommendations?
Yes, I think you're just discussing autos. I have Bajaj Auto as a recommendation. It's just, signaled or fired multiple crossovers on the hourly and the 2-hourly chart. So Bajaj Auto is a buy with a stop at 95.40. Look for targets of around 9,800 here. And the other one is Muthoot Finance, which I would recommend buying with a stop at 1785 for targets of 1865.
Muthoot Finance and Bajaj Auto on Mitesh's radar. Thank you very much for that. Get into a break. On the other side, market fundamentals with Pawan Parekh of Geojit Financial.
Well, not too far away. Just about, it's still a little bit of a distance. I mean, we're still talking, 50 odd points from that new level. Let's see if we indeed hit that mark today. Pawan Parekh from Geojit Financial is with us now. Pawan, good to have you on. So, tell us, I think the narrative that we're seeing increasingly around us now is on earnings, the fact that there is a bit of a slowdown. And that perhaps the first quarter has not been as charitable. Does that concern you at all, or do you think the bulls can continue their forward march?
No, honestly, going into the results season, I must tell you, Q1 is generally a soft season for the entire country for most of the business, except for some seasonal businesses. Q1 is generally a soft quarter. And add to that, we had, elections around. So I think it was widely expected that, Q1 is going to be a soft quarter. I think the bigger worry out here is actually valuations, because we are all aware of the India growth story. And I think more than adequate has been spoken about it. But the fact is that market is just going one way. And I must tell you, valuations are obviously not comfortable across a lot of sectors and stocks. And hence, it's very important to have a margin of safety in the earnings from a full year point of view. Because if you believe that companies are not going to deliver on the full year estimates, then you don't have margin safety. And in case of any big disappointment coming up in Q2 or Q3, I would want to believe that that stock on a relative basis will not work, or on an actual basis also can fall quite a bit. So I think that is the challenge in the market. I think Q1 per se, it was widely expected that it will be a soft quarter.
Pawan, I remember in one of our earlier conversations, you were talking about the EV theme and how you're playing it via auto ancillaries, and you had stocks like Varroc Engineering. And I think there was one more, Endurance. So now you've got this pure play two-wheeler EV, Ola Electric, which is coming into the market. It's, have you looked at the RHP? What are your thoughts on Ola Electric? And is this attractive for retail shareholders?
So without commenting anything specific on the company, I must tell you I continue to remain very positive on the EV story, and especially in the two-wheeler space. I think two-wheeler and three-wheeler obviously will be the first segment wherein EV is going to make some significant strides. But having said that, I must also tell you that Ola and Ather have made some very important marks. But a lot of these listed incumbents or the old guys in the market, even you need to wait and watch as to what their strategy is going to be the next 1 year. So while we think the EV as a story will do very well, but eventually where will market share settle down for between these players is something a wait or watch for us. And when we don't know which OEM is going to maintain how much market share, we are better off playing that story through auto anchors. So that is what our strategy continues to be. We continue to play the EV story via auto anchors rather than banking on the OEMs. Secondly, if you look at the commentary what Bajaj Auto's management has given, and even you look at the Ola's number also, obviously they're not making adequate money on their EV venture. So at what level will they break even, and how will the industry pan out? Will they take price hikes to have break even? And at that price hikes, will the demand will be maintained for 1 or 2 or 3 quarters? I mean, these are all a lot of imponderables, and it is better to, and from our point of view, it is better to play it through auto anchors rather than playing it through OEMs.
Okay. So auto ancillaries is a place that you're liking. Pawan, what about consumer? We were just discussing with our colleague Manglam, Colgate's, for instance, very good performance. Some of the other companies are also talking about green shoots in rural, more spending in rural, etc. How are you positioned on that side of the market?
So I think we are also quite positive on the consumer story. I think a lot of the companies in their recent commentaries have highlighted that rural recovery is something that they are witnessing some green shoots out there. I must tell you, after 3-4 years of underperformance, a lot of these stocks, both on the consumer staple side and also on the consumer discretionary side, have become quite, from a valuation point of view, they've become quite palatable. So that is one sector where I would want to be over it at this point in time, because the risk to reward ratio seems to be quite favorable there.
Pawan, in cement, the big are getting bigger, but you're negative on the sector. Why is that?
See, I think, cement earlier we used to play because we used to see that as a proxy to infra. Now that even infrastructure stocks or sectors is doing so very well, most of the companies have delivered themselves. A lot of the companies are talking about, moderation in their working capital requirement. Cash flows are looking good. Order inflows are looking good. So cement no longer is a proxy play to infra. Okay. As far as the sector is concerned, I think, they are still quite far away from the margins in terms of EBITDA per ton that they used to do in last 3-4 years, but the valuation is sky high. Perhaps the valuation is because of the consolidation that is going in the industry. But, from a risk reward perspective, we don't find cement attractive. And the main reason why we used to play cement, I think that is no longer there, because there are a lot of play available on the infra side itself. And I think earlier we used to play only through infra, but now you can also play through industrials, you can play renewables. So the pack itself has become quite wide. So it doesn't make really, I mean, from our point of view, it doesn't really make too much sense to have a lot of position in cement at this point in time.
Okay. So now anything else economy facing? Not really cement because of the reasons you mentioned. Anything else on the old economy side?
I think power is one theme. The entire sector has done extremely well, but I think we are nowhere closer to the highs. I think we are just less than half mark to the peak. In last 10 years, we've hardly invested into creation of new capacities. And mind you, even if now when we're investing in capacities, all of these capacities will come in next 3, 4, 5, 6 years. Okay. So power is, and if India has to do well, if India's story has to do well, if digital India has to do well, if India overall the economy has to do well, power demand will obviously rise. And I think at least for next 4 or 5 years, there's going to be a big imbalance as far as power demand supply is concerned. And within that, you look at utilities. Despite the run up, I think valuations are still fine. They are just closer to the average valuations of the last, say, 10 years or so. And I would want to believe that in the upcycle, they would trade at a significant premium to their last 10-year valuations. In fact, something which was very similar to what we've seen in 2003 to 2007 cycle. And I must tell you, there's a lot of power ancillary play also in terms of power generation, power T&D, renewables, industrials. I think that is one pack which looks very, very, very interesting to us. And mind you, again, I mean, this is one sector wherein there's a lot of deleveraging that has happened. And I would want to believe that in next 2-3 years, there will be a couple of pure play green IPPs which will get listed to further widen this space. So this is one sector, I think, from the old economy, as you just highlighted, which is back with a bang. And I think this should do extremely well over the next, say, 3, 4, 5 years.
Thank you, Pavan, for joining in. By the way, the market cap of BSE listed companies is now at a record high, crossing $5.5 trillion for the first time ever. Another milestone ticked. Get into a break. On the other side, more on markets. Welcome back. RBI has said that the coming new issue of the 14-year and 30-year government bonds won't be issued under the FAR route or the fully accessible route, which means foreigners can't buy unlimited quantities of these bonds. What does this mean? Lata is here with her editor's take. Lata.
Well, the FAR bonds were announced in FY20 actually. The idea being that these bonds, that only if you have unlimited foreign access into a bond will it be included in the index. So that was when this whole rule came into existence. We got included in the index only earlier this year. But what the Reserve Bank is now saying is that this FAR bonds, which were already issued, yes, you have foreigners have full access, but new issuances of the 14-year bond and the 30-year bond, which originally were issued under the FAR route, will now be issued under the non-FAR route. What is the non-FAR route? The non-FAR route says that foreigners can buy only up to 6% of any bond. That used to be the done thing till, the FAR as a concept was introduced in FY20. Although we introduced in FY20, only slowly were bonds issued under that category. But now, even the earlier issued bond, those earlier issued bonds remain FAR. But the new ones of the same tenor will not be issuable, will not be considered FAR. Now, this obviously has led to a bit of misgivings among some dealers who are worried that foreigners may react with, there is policy flip-flop in India, policy uncertainty in India. But as you will notice, there has been no impact on the bond market. Yields actually early morning fell a bit in response to the US bond yield fall. And that's because anyway, the total amount of FAR bonds already issued is 400 billion. Because of the index, how much is coming into the system? 25 billion or 30 billion when the entire 10% weight of India is realized sometime in March 2025 in the JPM index. So there's enough available. As it is, foreigners are interested only in the shorter paper, that is 5-year and below paper. Within these 14-year and 30-year bond, they have hardly bought, about 600, 700 million out of, they're very far from the 6% cap itself. They have hit the 6% cap in the 14-year paper, but in the already issued bonds, there is no cap. It's only in the new bonds. It's not going to have a material impact. In fact, it's going to have no impact at all. But we will have to wait and see if people start criticizing India's toing and froing on policies.
So basically, earlier FIs could buy up to whatever quantity.
Earlier, FIs could buy only 6% of any bond. After FY20, specified FAR bonds,
the FAR bonds,
they could buy what you said, whatever, 100%. Okay. Now, in the same bonds, the new issuances will be only 6%. So it's not a big restriction. See, the big point is Reserve Bank was never in favor of these kinds of things because they don't want India to depend on debt. It is always unlimited equity. but debt restrict because you don't want to be indebted to foreign hands. As well, the tail can wag the dog. That fear is always there. Something emerging market bonds are dumped because of some
sudden exodus.
Yeah, because of some war or some financial market disaster. You will get clubbed irrespective of your fiscal discipline or irrespective of your growth story. So they don't like to be, at the mercy of foreigners.
Okay, so not fully available, at least for these, new papers that will be issued under these tenors. Thank you, Lata, so much for explaining that to us. We'll take a quick break on that note, come back with more on the markets in just a bit. Welcome back. Well, let's talk about the impact that the recent tax changes that have been announced in the budget by the finance minister. What is the impact that they are having on corporates? Well, several companies have already rushed to the street with perhaps buybacks on the horizon. Hormuz is here to take us through what has happened so far. Hormuz.
There is a rush of buybacks on Dalal Street. Now, call it coincidence or just an action and reaction. As many as 7 buyback proposals have either been announced or are to be announced in the next few days. Now, there may be a trigger behind this rush as well. Now, the Finance Minister, Nirmala Sitharaman, in her budget speech last Tuesday, which was the 23rd of July, proposed that the income received via share buybacks will now be taxed at the hands of the shareholder instead of the company, now similar to how dividends are taxed. Now, some market participants worried that such a move may be counterproductive for the industry altogether. But let's take a look at some of the upcoming announcements that were announced post the budget speech. Now, Indus Towers' board meets as early as today. Now, this will be their first share buyback in 8 years. Now, in news just came in, TTK Prestige will consider its buyback proposal on the 2nd of August. Savita Oil on the 3rd of August, Serra Sanitary Ware on the 3rd of August, on the 5th of August, and AIA Engineering on the 7th of August. Aurobindo Pharma, whose buyback was approved before the budget announcement, had its record date, now which is in today's trading session. Now, Wellspun Living also announced its share buyback last week after the budget, and the record date for that has been fixed as the 5th of August. Now, this sudden rush of buybacks has put the spotlight on India's IT companies who are regular announcers or executors of buybacks to reward their shareholders. Now, the SEBI regulation mandates that there needs to be a cool-off period of at least 365 days between 2 buybacks. Now, let's take a look at how these IT companies are placed as of date. TCS, India's largest IT services company, carried out a buyback as early as last year. Now, can it announce another one before the 1st of October, which is when these changes kick in? Well, no, it can't. And that is because the board approval for the previous buyback came on the 20th of October 2023, which means that it will have to wait at least until 20th of October 2024 to seek an approval for another buyback. Now, Infosys also carried out a buyback last year, but unlike TCS, it is eligible to carry out a buyback as its previous one ended in February of last year, meaning that the 12-month cool-off period has passed. HCL Tech has not carried out a buyback since 2018. It can do so now if need be. Wipro too is eligible for announcing a buyback as its previous one closed in June of 2023. Now, Tech Mahindra too has not done a buyback in 5 years, while LTIM has not done one to begin with. So these two are also eligible for the same. Now, besides these IT companies, there are many others on the last street that regularly carry out share buybacks. I'm highlighting 3 of them here. Ajanta Pharma is the first one. Now, in the last 5 years, the company has carried out buybacks in 2019, 22, 23, and last year as well. But it cannot announce a new one recently, and it will have to wait until May of 2025 to announce another buyback. India Mart is the other one, and that has also been rewarding shareholders either via bonuses or buybacks. And this company has also done buybacks in 22 and 23. Now, the board approval for the last one came in July of 23, so now it is eligible to announce a new one since the 1-year period has passed. And lastly, Aarti Drugs, which carried out buybacks in 2016, 18, 19, 21, and 23 as well. And similar to India Mart, even they got a board approval on the 21st of July, which makes it eligible for a fresh one. So this is summarizing the recent spate of buybacks on Dalal Street. Now, it remains to be seen whether more companies join this buyback bandwagon.
Okay, thank you very much for that interesting analysis. With that, we're going to wrap up on Trading Hour from the entire team. Thank you for watching.